Great.
Thank you so much for joining us today. We've got today Sheldon Brown. He is a mortgage broker with Mortgage Architects. And given everything that's going on, it feels like any penny in the sky is falling. So, let's talk about mortgages. We generally don't talk to people about money, but right now we got to talk about money. We got to talk about the decisions people are making and what's going on with the banking industry, because there is so much going on that it's really important. So, Sheldon, why don't you give us a little bit of information about your background and how long you've been a mortgage broker for?
Sure. So I've been working in mortgages and lending for since just about 20 years at this point. I started with two of the big five banks in my first 11 years, and then moved over and was licensed as a broker in 2009. Something I'll add in is that so 2009 was the first recession that I was working in lending. Where we had another one in 2015, a mild one, and it looks like we're going into our third. So I do have an understanding of the back end, which is how the underwriting would be assessed, during a recession, and it impacts those who are purchasing. It also impacts those who are looking to refinance and take equity out of their property. So certainly, I think it's a great discussion. I'll preface it with the fact that I am a mortgage broker, and as with mortgage brokers, mortgage specialists, mortgage advisors, and underwriters, we do represent the origination side of lending, or the new money, which is we're always looking at the borrower and what they're accepting coming in. But I would just say this for those who have specific questions about their institution in particular. Although I'm going to generally speak to how mortgage underwriting policies, mortgage servicing policy is affected with this. I would also encourage anybody to take this information and specific to your scenario might be best to speak to your mortgage servicing department.
Perfect. That's a great lead up. So let's talk about mortgage deferrals, because that's something that came out in the news over the last couple of weeks. And you mentioned earlier that, they had come out with this mortgage deferrals, I guess probably about 2 weeks ago now. Mm-hmm. And now things have changed slightly. So do you want to talk to us a little bit about that?
Absolutely. And so essentially, the mortgage deferral, I've speaking to clients of mine who've called in and asked questions. The reality is it's you're not canceling a mortgage payment, and that seemed to be the impression that I have. What I would think some people would assume this is. It's not a giveaway. You're essentially delaying your interest and not paying any principal with your mortgage for a period of time. And with that, to understand, I guess, the structure of it is that from the point you start the deferral and your payments stop, what happens then is the end of that deferral period, once your payments start again, your principal and interest payments start again, your interest on the period that you've not paid your mortgage is added on to your mortgage balance. Whereas mortgages are compounding interest, and with that, you'd be paying interest upon interest essentially at the end. But with that being said, I mean, my position's evolved quite a bit since the start, because I was speaking to clients who I understood did not necessarily need to defer their payments. They could service it through their savings and so forth. And my position was, I think it's a bad idea from the financial impact of you're going to pay more interest later. In addition to that, once your deferral period is over, your mortgage balance is higher than it was when you started, in which case your principal and interest payments are now reset to the new mortgage amount, because the amortization or the life of your mortgage isn't extended with this program. What it is it stays the same. So for you to complete your term or the contract of your mortgage, your payment is adjusted, so you will pay the shortfall over the remaining of the term. So it does increase your mortgage payment slightly. It's not, it wouldn't, count for more than maybe 20% more, probably even less than, could be around 10 to 20% more, or even less than that. But it is something certainly that I had started this looking at this more as a setback, for anybody who can service this. But, as I said, my position evolved, in the last 2 weeks, I've come to appreciate that we really there isn't any certainty on a timeline for this and when we'll be back to normal. And versus not making your mortgage payments at all and not asking for this program, in which case you'd be in default. It is best to consider this program if you have to.
So how does that affect your credit score? Because there's been lots of talk about this affecting your credit score. So can you tell us a little bit about that?
Yes. So your credit bureau would not be impacted or should not be impacted by this because you're not in default. So there shouldn't be any impact at all to your credit bureau. However, this is a scenario where you're not making your mortgage payments, even though it isn't a default. And I've had this conversation with somebody else. I said, there is a measure of financial maturity in any product you have, and that box may not be checked when a lender is looking at you down the road. The lender that you're with is looking at you for maybe refinancing reasons and so forth. And it doesn't necessarily mean that it's a negative mark on you, but it certainly wouldn't demonstrate that you had the ability to work through this with your own savings. So, but I'm careful with that because there wouldn't be a negative impact on your credit bureau. In addition to that, when you look at your mortgage statement or your history, it's not necessarily that you're in arrears, but you have had a deferment, right? So I would say that if the concern there is the impact to your credit, I would say I wouldn't worry about that. I would just say that if you're someone where this deferment would end and you have a shorter period till the maturity of your term, and you may be looking to port an increase or transfer your mortgage and increase the mortgage or refinance, there is a possibility that your repayment performance is recorded, right? And this is where you will not check that box.
Interesting. So talk to me a little bit about interest, for example. So one of the things you mentioned was, you defer the mortgage payment, you're going to be paying interest upon interest, essentially is what you said.
Yes.
Can you mitigate that by, let's say, over the next 6 months, I defer my mortgage.
Yeah.
Let's say by the end of the year, everything is okay, and I put some lump sum payments toward that mortgage. Can I mitigate the interest essentially from doing that?
So that's tricky because essentially because the lender or the bank or the credit union, they mitigate it by adjusting your principal and interest payment, which is what they have to do because you now have your principal and interest payments are based off of your mortgage balance. And when your mortgage balance is higher, there has to be an adjustment there. So you are still falling within what your amortization period would be. So the mitigation is actually done by the lender in this case. However, paying anything, once everything's back to normal, anything you pay outside of your scheduled interest payments are all to principal. So, you can cut time off, but essentially the lender is actually mitigating it for you by adjusting your principal interest payment where it will be increased slightly.
Interesting. And so is there any difference between the lenders? And I know that there's sort of Schedule A banks. Are there differences between, let's say, Scotiabank and BMO? And then the other question is, and what about a bank like Meridian? Because Meridian is a credit union. It's governed by our Ontario rules as opposed to the other banks that are governed nationally.
Yes. So credit unions who are governed provincially, they, from the conversations I've had with a number of them, are still participating in the deferral program. When this all started, where there was questions whether investment properties would be included, whether it would be case by case or whether there'd be required some proof of your financial hardship. When all those discussions were happening, it was the credit unions were involved in that as well, and the feedback that I was hearing, which is it's a case by case, and which is a term that everybody likes to use, but they don't want to use a blanket term, which is everybody can. Because what's happening now is, there's I think there's one of the banks that I'm partnered with, the development manager there said they were up to I think 26,000 emails on this line that they have open. So it's just one of those things where every institution will, I believe, at this point fall in step. As I've evolved, I think our lenders have in Ontario, where I believe they will. Only that it is best because I know with credit unions they are not governed federally. It is always best to kind of confirm where they would stand with something that may be just outside, like an investment property or a secured line of credit or things like that. So that's where invest could still be case by case in that regard.
So then, I mean, you kind of alluded to there is a difference between a primary residence and an investment property. Mm-hmm. Are the banks treating those blanket a certain way, or are they all still case by case basis?
So for the most part, they are now. I know, and I guess, to the defense of mortgage lenders, when the government kind of hoisted it on everybody's lap that this is that this accommodation should be kind of extended to borrowers. Everybody was left scrambling to figure out how to apply, and they were doing this shuffle with less staff or remote staff and things like that. So I believe there was a lot of rumors that came out at that time, and I believe for the most part, across the board, it is a program that's being adopted by all lenders. And then when it comes to secured lines of credit, my understanding, and I can speak to the banks and the lenders that I've spoke with, it is technically going to work the same, only that your interest is deferred, but when you start again, there isn't a principal portion. With a secured line of credit, it is interest only. But so the premise is you'll still be paying the interest upon interest, but there would be no adjustment in terms of paying it off within an amortization.
Interesting. So whether you have a mortgage or like a HELOC, like a homeowner's line of equity, if they're almost treated the same in terms of that you can defer them.
Yes, with the lender partners that I spoke with, yes. And
they're allowing you to defer between sort of like 1 month, 2 months, 6 months. What's sort of the average?
The period I know is a max of 6 months. I believe the approach there is to see what the borrower would be requesting. So I know when you call in, so you just get this. It's what do you need? How are things going? And then basically the timeline is worked out from there. But the structure would be the same, which is you stop interest. If you're in a mortgage, principal stops as well, obviously. And then when you start again, you are at a higher balance because now your interest is added to your balance, and you're doing that. You're paying the interest compounded on that interest. You start again.
Interesting. So then I guess, would you recommend that people defer or not defer their mortgage payments?
You know what? Because I wouldn't just say, if you've been laid off, do it. I wouldn't just say, if you have a tenant that's not paying their rent, do it. I would really look at your situation, because ultimately you're paying for this, right? You're paying interest upon interest, right? And that doesn't go away. But that being said, on the other side, this relief is needed, for some people. So I would say, if you can avoid it, do so. If you can hold off, and which is, I have a rental property and I have a duplex, and one of my tenants is not paying their rent, and my personal position is to hold off, see how things work in the next month or so. If we see kind of a path out of this, I'll kind of hold off. But it's much more challenging, to service the mortgage that doesn't shelter you. And I guess, and in terms of how lenders look at, investment properties versus primary properties is just that. There's always a higher risk of default with rental properties, because the mortgage you're going to pay is the one that's sheltering you. And so that's why when this all started, there were conversations about not including investment properties, but at this point, they are treated all in the same bucket.
Interesting. It's funny because I've got some investment properties myself. And so one of them is with Meridian, and they were actually really easy to deal with. All I had to do was fill out a form online. They called me the next day and they said they would give me the 1 month deferral, no problem. And that was really the end of it. It was super easy.
Right.
And then for my principal residence, I deal with BMO. They took a lot longer to get in touch with. It was almost impossible. It's only because I have the phone number of somebody there. I had to wait for them to come back from vacation to then figure out what to do, to then call me back. And again, once the person got in touch with me, they said, yeah, we can do 6 months, no problem. So it was kind of really interesting. I think it's almost like the longer you wait, the easier it became to get the answer that you wanted from the lenders.
Yes.
the first day they came out with this, I kind of felt like, is this a PR stunt? Because it sort of felt like that because none of the banks were actually ready
Right.
to, have consumers ask them the question. Great, I want to defer the mortgage.
Right.
So yeah, it's interesting that over time they have kind of evolved, and even with lines of credit, that's part of what they're doing as well too.
Absolutely. I think it's great. One of the things, coming from the bank and now being partnered with the banks, I think it's one of the great things I could say is that, we've all tried to really get around this and remove, the stigma behind not paying your mortgage. You know what I mean? And I think that was one of the things that I had going into this, coming back from my background. I said, don't do it. Don't do it. I had a friend that I was saying, just don't do it because you can afford this. But the reality is we're going to go through we're still in a period of uncertainty. We don't know when things are going to come around. I would only say, speaking to kind of my personal take on it, which is what I'm doing, which is I'm going to wait and see for a little bit longer. And by that time, a lot of the lines have cleared out. so just even getting through, because I know you could be a number of hours on the phone from the feedback that I've been given. So I think wait and see approach would be mine. But I would say if you're somebody who is on the verge of not paying your mortgage at all, I think you should be spending your time on the phone to get that program started for you, because it would look a lot worse as a default versus starting this deferral.
Absolutely. I mean, I think of it more of shoring up cash, because we're in such uncertain times that we don't know what's happening.
Right.
And by the time, I guess my adage is always go get the money when you don't need it, so that at least when you need it, it's available to you, versus waiting till things go off the rails and all of a sudden then you're stressed out and in a panic that you need it. So for me, it's like, let me go get all that money now, shore up my cash reserve so I know that everything's okay and I can sleep at night. And then, at least I know I'm sort of covered off if things go bad later on, but hopefully, we'll be able to get back to some sort of semblance of living in a couple of months. Who knows, right?
Right. Absolutely.
Absolutely. Do you want to talk to us a little bit about interest rates right now?
Sure. Absolutely.
A few weeks, we've seen the Bank of Canada bring down their lending rate. I think that banks are increasing their fixed rate. So maybe just talk to us a little bit about fixed rates versus variable rates, what they're like now, what they sort of used to be like.
Absolutely. And I mean, I'll start with fixed rates because that has seen the most volatility. I think it was, we started seeing, so what happened in the last month is the bond markets, the bond market yields are the indicators for what influence fixed rates started to drop, and fixed rates started to drop. And then, we went into this period. So this is prior to the shutdown of the government and so forth. So this would have been about a month ago. So I was across the lenders that I'm partnered with and the banks. My rates were closer to 2.4% for a 5-year fixed, and that was a month ago. And then around 2.5 weeks ago, rates started to go up, and it wasn't by the traditional indicator of the bond market. It was more of capital and liquidity premiums and capital concerns, because where the investment, where the money that's being lent to you, that's being borrowed, the investment into those lenders for bonds we're also not coming in as much. So this is across the board, because this is what's influenced the rates. The current increase that we had, rates have increased almost, I would say almost 60 basis points or 0.6% across the board with all lenders. And that's really come from the concerns with liquidity, or the best way to look at it is the capital that's used to lend is now being looked at with concern, right? And so that's what's raised the rates. So right now, as it is today, getting a rate under 3%, would really require, a good relationship with your broker or your mortgage specialist. And in most cases, most lenders, banks and credit unions are around the 3.2% mark right now. So rates have increased, a fair amount in a very short period. Now, when it comes to variable rates, which is a bit more straightforward, they're directly related to the Bank of Canada's prime rate. We've seen drops in prime over the last 3 weeks. I don't know if you want me to wait on you, but I'm on variable now. So with variable rates, which is a bit more straightforward in terms of how they're influenced, Bank of Canada has dropped rates, dropped prime, and that will normally happen when we're trying to steer our way through a recession. And that has impacted our secured lines of credit, our variable rate mortgages. And so in terms of those rates, which are a bit more straightforward, what will normally happen when prime is dropping is the discounting on prime is shrinking with the lenders. So when you're offering, so if prime is, let's just do simple numbers, if prime was 3%, before this all happened, before we started seeing Bank of Canada drop prime, if it was 3%, normally a bank would say it's your rate is prime minus 0.5%, and then your rate is 2.5%. So that 0.5% discount does not change throughout the length of your term. Now, what happens there is when prime starts to drop, banks, mortgage lenders, credit unions, what they do is they reduce that a discount off of prime. And where we are today is most banks and lenders are adding a premium to prime. So where, now, the banks that you'll go to will normally say it's set at prime or it's prime plus 0.10. So in terms of what's happening now is the discounting on variable has changed a lot, where you're not seeing the discounting. I mean, I would say in February, I was doing prime minus 1.10. And the client that I did that with, their rate is, I believe, 1.65% right now, so, and that's basically their payments are based off that. And so with that, I mean, it's great, but those adjustments happen quite fast because it's, at this point, prime is now not discounted as much.
So it's interesting. So because your client locked into something before this happened, they're still going to get their prime minus whatever. They're not necessarily affected by it. So the rates going down is helpful to them.
Absolutely. If you were in a variable rate mortgage and took it prior to the last month, your rate will more than likely be under 2%. Bank prime is at 2.45. So with that, it's more than likely you're under 2% now, and so that's one of the nice things about what's happening in the market is that if you already had a variable rate mortgage, you're doing well. One thing I'll say is I have clients now asking about variable and looking for that, and with that, I think it always comes down to suitability and what works for you, which is first and foremost. But the back end of that is be careful if you're choosing a variable rate product at this point because of what you've seen, because of the drops that you've seen. And the reason why I say that is our prime is currently under the inflation rate, and which tells you that the governor will look at increasing, and it's not by a quarter. They're likely going to snap back just as they snap down or drop the rates. So be careful with making the product decision based off what's happening now, because we could see, if we turn this corner and we kind of work through and we're not fully in a recession and it doesn't go through the full recession, we could see prime start to come back up. Because one of the things that happens with a low prime, just sort of monetary policy, it's, people are going to borrow, right? And you don't want people borrowing too much during a recession, and also you also don't want inflation rate to go up. So I think it's one of those things that this is certainly not a long-term stay for this, but I could say you'll be saving a lot of money in the next 12 months if you do choose it. Just be prepared that locking into fixed might be in the near, could be an option for you in the next 2 to 3 years.
Right. So let's talk a little bit about the difference between, let's talk about the spread between the variable rate and the fixed rate.
Okay.
Because at some point, the variable rate and the fixed rate were so close together, for a lot of people looking at mortgages, they figured they might as well go with the fixed rate because there was barely a difference between fixed and variable.
Right.
So right now, are you seeing those rates still close together, or now they starting to spread out a little bit?
So now, I have a personal story to this because, for I think almost 15 years, I've only ever had variable rate mortgages, whether it's my rental property or my primary property. and I've done well. I've had a good stretch. In the 2012 to 18, we had a really good run where I saved a lot of money and I put a lot more down on my equity because of the variable rate mortgage. Now, what's happened in the last, I would say, probably 14 months is I believe that the indicators were there where I expected to see a drop in prime. Where we did not, right? And our economy was not growing, and sorry, it wasn't growing, it was shrinking, but I guess not to the point where the governor wanted to drop prime by even a quarter. And we went through that period. And so with that, prime has been at 3% for the last, I shouldn't put a date here, but it's been over 2 years. And prime has been at that point, whereas what we saw around December, where rates started to drop, is prime was higher than where fixed rates were, and when we got to the point where we were doing 2.5% for a broker that for himself chooses variable, and for my clients, it comes down to suitability. But if it's a rental property, the flexibility of being able to sell a property and not paying a profit loss calculator on it is where I say it's good for good for rental properties. But at this point now, we are seeing variable, even with no discounting, significantly less than where fixed rates are. It's only almost 0.5%. So I would say, it's tricky, because I think, if you have a good fixed rate, with fixed rates, we've only been under 3% handful of times in the last 20 years. If you can, the principle there is if you can secure a low fixed rate for your term, then you're better off than hoping things come down or things go up, right? So I would say that we're at the point now where it's more of a discussion, fixed or variable, because variable is lower than fixed at this point. But where with the bond yields are today, when the economy starts to maybe make a turn on this, where capital is flowing more, then we may see those rates come down with fixed rates.
Interesting. So right now, are you recommending to your clients that they consider doing a fixed rate mortgage or a variable rate mortgage?
At this point, it really depends on the client and the type of purchase. For your primary, I'd probably still be partial to fixed, where, I am still doing under 3% for fixed. And I have great lending partners, where I have status relationships, why I'm still able to do that. But I'm not blind to the interest rate savings that you'll have with a variable. I would only say that I'm suspect on how long that's going to last. And the thing is, I think I'm an optimist when it comes to our economy. Probably too much of an optimist, but I see our economy picking up sooner than going through a traditional recession, but where this is because of a world event. So I would say I'm still on the fixed side for your principal, and then for rental, I'm always partial to variable. I like the flexibility.
Interesting. So then, in terms of, let's talk about refinancing. Now a good time for people to refinance debt, or would you say it's not a good time?
Well, one of the things, refinancing to consolidate high interest debt, I think, is always a good thing. I think there's no downside to that. The one thing I would say, though, is one of the things that's happening on the back end, which is underwriting, is where you'll see a bit more scrutiny is when you're refinancing just for equity takeout. So where you're not consolidating debts, you're not, there's no direction to, something that you're doing on your property or renovation is kind of always suspect anyway, but when it comes down to is there may be more scrutiny around just taking funds out. And I have clients that will refinance for investment, to purchase investment. And with that, it's not, there has to be more of an explanation. I know in the last 10 years, equity takeouts, refinancing to take out equity for more than $200,000 would always have scrutiny. I believe that that metric or that threshold is probably dropped significantly because we know we're going into recession. But certainly refinancing to consolidate high interest debt, I think it will be supported by the lender because your financial position would improve when you're servicing debt at a lower interest rate, and it's a structured repayment of it because it's now in your mortgage. But I would, those who might want to be looking to take advantage of the scenario where they want capital in a recession, it's always good for real estate as well. If you're the one with capital, I would just say to certainly, it depends on the lending institution. You may have some pushback.
Right. Got it. We've got a question here from Rohan. He wants to find out, what is the loan to value ratio for rental property versus primary residence?
Now, for purchasing a rental property, that is not, could not be insured. So being default insurance through CMHC and Genworth, they do not insure rental properties, which means that your minimum down payment would be 20% on a rental property. And then purchasing a property to live in yourself, which can be insured, would be a minimum of 5% down. Adding to that, if you're purchasing a secondary property for another family member, so it'd have to be arm's length. In that scenario, you can also put a minimum of 5% down.
Got it. And what about, are there scenarios where for investment properties, lenders ask for even more than 20% down, 30% down, or 50% down?
Well, yes. It would depend on property type first. If you're looking at a multi-residential property, you may be required to put down as much as 25%. It also depends on the covenant or the borrower, where if you're purchasing, if you're somebody who's a non-resident, the minimum down payment for a property could be 35% down. So it really depends on the type of application, but for the most part, 20% should be sufficient. If your application is not as strong, or perhaps the property, depending on the market that you're renting in, this also comes down to what type of lender you're looking at, because a subprime lender would be more conscious of the market that they're lending in. So usually a population size of 200,000 people, they would want more than 20%.
Got it. That makes sense. We've got another question here about refinancing on an existing rental property. What if you're looking to take cash out of that?
Yeah, no, absolutely. And that's certainly it comes back to where we discussed before, is that, it's a good discussion to have with your mortgage specialist. But certainly you can refinance an existing rental property up to the 20% as a max, so 20% of the appraised value. One of the good exercises to do when you are considering refinancing your a rental property or any property is to look at, within the last 6 months, what have comparable properties sold for, and that's a good indicator of where your value would be, because that 20% also just means that you can borrow up to 80% of the value of that property. So just to make sure that you have your expectations set for how the application would go, because an appraiser will be doing the same assessment where it's a direct comparison approach, where they'll look at a property that has sold within 5 kilometers normally, and then their skill is used to kind of make adjustments for property type and amenities and things like that.
And what about with that existing rental property? Let's say you didn't want to refinance it, but you just wanted to get a line of credit on it. Something like that.
Yes. So a secured line of credit or a credit home line plan and so forth. So not every lending institution will allow a secure line of credit on a rental property. So that's just something to note. So it is specific to lenders. So that's just one thing that you would have to be careful of. They may not all accept it. But for the most part, the banks that I'm partnered with and the credit unions that I work with, they all do, but there are banks that do not allow that. Right. So that's the only thing I'd be cautious of. But when it comes to a secured line of credit, it would function or be structured the same way, where your limit would be within 80% of the value of the property. So just like, but in that case, so I would say to add to that is, if you were somebody who may not have an immediate use for the funds, or are looking at the recession where you might want to have capital for this and for real estate investment, I would likely suggest looking at a secured line of credit for a client, because one of the things is, if you refinance and the date your refinance closes, you're paying interest on those funds, right? And if there's no immediate use for it, you're still paying the interest on it. and then the funds are transferred to your account and you're sitting on it. Now, when it comes to a secured line of credit, now with prime where it is, I mean, you're paying no interest if it's just a limit that you have, and you don't have to go to the bank every time you use it. And then with that as well, there wouldn't be any scrutiny because it's a secured line of credit. It's not all cash being issued. So I would probably even suggest that if there is an immediate use to look at a secured line of credit to be added behind your mortgage.
Perfect. That's great. Any other questions out there? Any burning questions you guys are dying to know? Going once? Going twice? No other questions out there? Oh, hold on. I think there's a question coming in. Sean, do you have a question for us?
Yeah, I've got some clients who, they're weary. They can carry their mortgage, and I think you kind of already answered this, but I'm just interested maybe a different take. I've got some clients who, I'm an investment advisor, so some look to me for, financial advice, and I've got some clients who can carry their mortgage currently, but their prospects of keeping their job, i.e. situation could get worse and they expect to be laid off or let go. Mm-hmm. I'm in the camp as develop, maybe shore up some income and delay a few months, keep that money on the sidelines, or, invest in a high interest savings account within your tax savings account so you at least get, something for it. And then could you not, like you mentioned rejigging the schedule, but can you not just make a lump sum payment to make that up? Is that not possible?
Well, and I think that's where kind of I think that falls into where I am, where it's kind of more of the wait and see. I'd just be kind of more partial to kind of waiting and seeing whether we will not by the summer still not see people back at work or something like that. If that's a scenario, then I think it makes sense to shore up. The truth is the expense of that decision is really nominal when it comes down to it, because when it comes down to it, if you look at for 6 months, the adjustment that's going to have, because paying the lump sum, that's not the mitigation here of this process. The mitigation is done by the bank itself to say, so now you've had your mortgage, you haven't paid interest or principal interest. As a matter for them, it's the interest hasn't been paid for 6 months. All the principal that for the 6 months hasn't been paid either. So your mortgage balance now is $14,000 more or $20,000 more. So now what we do is we say with a 25-year amortization with this mortgage balance, the principal interest payment has to be adjusted so you still pay off your mortgage within that timeline. So I would think the way to the reason to mitigate would be to say, I don't want to keep my mortgage for 27 years now. It was 25 years before I started. That's being done by the bank or the lender already for you. So, any lump sum would set you ahead because then you're paying down any lump sum or payment outside of interest is all to principal anyway. So you could still certainly do that. But I would just say that, if you're waiting and seeing, in 2 months, I think, if we're in a position where just as I've evolved in the last 2 weeks, I think what will happen is if we are looking past May, I think the attitudes towards, whether to do it just in case will change a lot as well.
Got it. So it's a roving idea. So
absolutely,
it changes.
It's not set in stone for sure. And the hope there is, it's that by the summer, things go back to normal. I certainly myself, I'm fortunate that being in the business for a number of years and managing a group of other mortgage agents, where I'm still working and I'm still supporting clients, and the clients that my existing clients come for renewal each month, and I still support them with that. We still look at refinancing. So I can't necessarily, it's business as usual, but I believe at this point it's having a mortgage professional help you navigate through. I know you want to buy that rental property and take $200,000 out. There's a way to kind of look at that, whether it be through a home equity line of credit or refinancing and paying off some debts and then using the debt, there's the free balance on your debts. So there's ways to maneuver through borrowing in a recession. And I think that's where a good mortgage professional can help.
Interesting. And so I think you had mentioned at the beginning that you have, I think you said this would be, assuming we're going to go to a recession in the next couple of months, this essentially would be the third recession that you've worked through.
Yes.
So can you tell us, have there been any patterns that you have seen with respect to lending when we're in a recessionary period?
Yes, certainly. It's I hate to use the word credit crunch, but when it comes to refinancing and taking out equity, I think that is where the scrutiny is applied most. The one thing I'll mention is that the last 2009, I had just started as a broker. And I was a mortgage agent at that time, and really wasn't responsible or supported anybody. In 2015, I was just starting as a broker manager and sort of had a small team at this point. Now, 2020, where if we do go into it, this being the third one, I have a bit of a different background now where I do a lot more non-institutional lending. And that's kind of been one of the differences there, where I always say, you learn all your options or discuss all your options, but there is a lending platform that is there for everybody. And to give you an example, I have a great client, works in the court system. The courts are closed, and not somebody you'd think would consider private lending. But with private lending, where if there's enough equity involved, having a prepaid loan, which is a term that not a lot of people realize, it just means you could take $100,000 and for $100,000, it's, let's just say 7% in a second mortgage. So around $890 each month is what you would be paying. Multiply that by 12, add that to the $100,000, then you've borrowed $120,000 and you've not made a payment for 12 months. And that was a solution that she wanted after discussing her options with institutional banking. That's where there's a lender, a lending type for everyone. I've been asked before, well, why would you lend to somebody in a scenario where this person couldn't finish a renovation and was in a position where her maturity of her term is coming up next year, and without a kitchen in place, we would have a challenge. And in that case, her priority was to finish that kitchen. And with the equity that's the house is going to go up, she understands that and understands the cost of borrowing with it. So I believe that going into this recession, where I have access to banks, credit unions, mortgage financing companies, as well as private lenders, mortgage investment companies, I think it gives me a better ability to kind of speak to different scenarios.
Got it. That's good. Any other questions out there? Going once, going twice. Okay, looks like we're done. Thank you so much for joining us, everyone, today. They will be sending out the playback later on, and then we'll be sending out a podcast later on as well, too. But thanks so much for joining, and hopefully everyone found it was useful and they got some really good information out of it. I'm sure I did. Thanks a lot, Sheldon.
Great. Well, thanks everybody for joining in, and thanks again to Val for making this happen.
No problem. Thanks, guys.
Bye.
Bye.